Welcome back, everybody, to Volatility Trading Strategies. So while I don't think it's quite the end times just yet, we are currently witnessing quite a spectacular market crash. As of March 12, 2020, on a close-to-close basis, the S&P 500 is down 26.74% from the all-time highs just a few weeks ago. For anyone taking score, that does take it back to the same level it was at on July 25, 2017. That's over 2.5 years of stock market gains wiped out in a couple of weeks. Now, thankfully here at VTS, we're not buy and hold investors. We tactically rotated into our safety positions and then full-on cash a couple weeks ago. But even just watching from the sidelines, it's been quite terrifying. And whenever the markets crash like this, I always think to myself, what about all those traders who just hold short volatility positions in the long run? The fact is, most of the time, the long volatility ETPs do just consistently go down, minus a few large spikes along the way, of course. This here is the 1x long volatility ETP called VXX. And yes, clearly it's been quite diabolical in the long run. And because of this, there are traders out there who just hold them short and hang on for the wild ride through the ups and downs. I've even seen people who manage trading businesses recommending this. It's crazy. I strongly recommend you don't do that. I've made several videos talking about the extreme dangers of shorting the volatility ETPs directly. So today I'm going to go through a live example just showing what would have happened if a trader just held on over the last couple of weeks. Send the kids to bed because it's about to be a horror show around here. So as always, subscribe to the channel, give the video a like for me, and let the games begin. So instead of just pointing out what a terrible idea it is to just short the volatility ETPs directly, I want to make this video educational and show you a much better method of going about the short volatility trade. You can take this method and adapt it to your own trading style, because there's nothing wrong with the short vol trade. If managed correctly, it can be very profitable in the long run. But the method for doing it and the underlying vehicle chosen really can make or break the strategy. I'm going to compare two methods today. The first one, which I don't think anybody should ever be doing, is shorting the VXX directly. And I'll compare that to my favorite method of shorting volatility, and that is buying long put options in VXX instead. To start things off, let's set a baseline comparison for a period that would have been an easy win. January 6, 2020 to January 21, 2020. That 2-week stretch was a standard run-of-the-mill stable market period where shorting VXX outright would have been a breeze. The VXX went from 1508 on January 6th to 1332 on January 21st. Being short the VXX directly, that's a profit of 11.67%. Now, I'm not going to include the fees to borrow the short shares or anything, but that's an easy 11.67% profit in a couple weeks. And now we'll compare that to a trader who, instead of shorting the VXX, they bought a long put option on the VXX instead. Remember, with long put options, if the underlying goes down, the trader makes a profit. So the entry price on January 6th would have been $9.08, and then exiting on January 21st at $10.25, that's a return on capital of 12.89%. But here's a little tip, and this is key. To make the trade much safer and add a level of built-in risk management, you can trade your put options in what is loosely called cash secured. This means reserving the full amount of capital required to hold the underlying shares, and only buying one option contract per 100 shares of value in the underlying. Since the VXX was trading at 1508 on the 6th of March, the long put buyer will only buy one option contract per $1,508 of available capital. If they have $5,000 to allocate, they only buy 3 option contracts. If they have $25,000, they can buy 16 contracts. Trading them cash secured means they're only actually allocating 60.21% of the capital for this trade and keeping the rest in cash. Now, when calculating a true rate of return, of course you always do have to factor in and include the idle cash in the portfolio return. So now the actual total return on investment for the long put buyer is 7.76%. That is a little lower than the 11.67% return the trader who shorted VXX outright would have made. So we can see in good times when the trade goes smoothly and it's just one of those easy wins, shorting the VXX directly may outperform the put buyer. So you may be asking, why would anybody actually want to do this? Well, here's where it gets interesting, and parental discretion is advised. Now we'll show a period where the trade didn't go so well. from the 19th of February 2020 to March 6, 2020. Shorting the VXX outright on the 19th at a price of $13.56, the trader could have covered their position on March 5th at $26.68, just before they lost it all. That is a short VXX return of minus 96.76%. So now let's see how the long put buyer would have done over the same time period. They buy their contract at $7.45 and sell it at $1.56 for a return on capital of minus 79.06%. But remember, they're only buying one option contract per $1,356 in available capital. That was the price on the opening day, to match what it would cost to hold 100 shares of the VXX directly. That means they're only allocating 54.94% of their capital and keeping the rest in cash. Now it means the total loss on investment was minus 43.44%. That's a whole lot better than the trader who shorted VXX outright and lost 96.76% of their capital. If this difference of losing 43.44% versus 96.76% seems trivial, maybe you're thinking both of them are going to be pretty miserable, I do have a saying that I always remind the VTS community of. Losses are far more costly to a fund than gains are beneficial. What I mean by this is, mathematically speaking, the larger the drawdown a trader suffers, it requires an exponentially larger subsequent profit to get back to the break-even point. So you can see here, if a trader suffers a 10% drawdown, it's not that bad. They can make 11% after that and get back to break-even. If they suffer a 40% drawdown, it now requires they make a 67% rate of return to get back their money. And a 90% drawdown requires the trader to make a 900% rate of return afterwards just to get back to break-even. And a side note, this is why it took the NASDAQ index 18 years to recover from the peak it was at in 2000. It lost 78% of its value in the dot-com bust, so it's going to take many years of gains just to get back to break-even. And it did, nearly 20 years. So here's our two examples from what would have happened in the last 2 weeks. The trader who understands risk management and used long VXX put options for a loss of 43.44%, well, they're not happy, of course, but they do only need to make 76.8% to get back to break even. With a good short volatility strategy, that is still within striking distance. But our reckless trader friend who had no concept of risk management, who just looked at a chart of the VXX that usually goes down and said, hey, I'm just going to short that, well, they lost 96.76% and now require a subsequent rate of return of 2,986%. If that number isn't alarming enough yet, putting it into perspective, even if that trader made a consistent profit of 25% a year every year going forward, which would easily put them in the top 1% of traders worldwide, by the way, not likely to happen given they're already in this drawdown to begin with, but even if they did make 25% a year, they'd still need to do it for over 15 years straight just to break even. So it's at this point that somebody in the comment section will say, well, you can just hang on to the short VXX position and wait for it to recover. It may take a few years, but it does always come back, right? So here's what would have happened in live trading, remember, this past week if the guy decided to just hang on for the ride. Instead of getting out just losing their full capital, now they're down 249.26%. That's devastating. They've now lost a massive chunk of the rest of their account as well. And if they over-allocated, maybe now they even owe the bank money. And they will come after you to collect that money. Don't think just because your account balance goes negative, they'll just close out your account. They will try to get it from you. So what about the smart trader using long VXX puts instead? Well, with a crash of the magnitude we've seen the past couple of weeks, they'll be out nearly all of their capital as well, of course. In this case, down 91.28%. But remember, using the cash-secured method, they've only allocated 54.94% of their capital, and the rest is in cash. With long put options, you can only lose what you put into the trade. So even the worst situation imaginable, they still only lost 50.15%. The trade could blow up completely, losing 100% of value, and they'll still only lose a maximum of 54.94% in the worst-case scenario. The short VXX trader, unlimited loss. So here's where those rank. The put buyer can still regroup. With patience and a good stretch of trades, maybe they can get it back. The person who shorted outright, well, have they found the fountain of youth? Because they're going to need several lifetimes to get this money back. And here again, I promise you, somebody is going to say, well, you just hang on for the ride, and eventually the VXX does always continue to go down. Okay, well, what if this is the start of the next recession? The market's only down 26% so far. But what if it's just on its way to being down 50% or more? Are you willing to bet your future and a bank potentially garnishing your wages for the next several years on a gamble that this isn't the start of the next recession? I sure hope not. The bottom line is, as a person who's been trading volatility for the better part of 15 years now, the short volatility trade is definitely one of the most profitable in my portfolio. I'm absolutely not saying that it's too dangerous and people shouldn't do it. Quite the contrary, I think it's a good idea for everyone to have a little bit of exposure to a consistent short volatility strategy. But not all of them are created equal. Some of them will provide you an excellent long-term rate of return and really good diversification. And then others will absolutely blow up your trading account. So just be careful who you listen to. There's a lot of dangerous and reckless advice floating around out there. If you like this video and you want to see how I personally navigate these difficult markets, you can head on over to my website. There's a free trial on there. You can check out some of my live trades and join the VTS community anytime. You're always welcome. Thanks for watching. Thank you so much for watching the video. So don't forget to subscribe to the channel and go check out my website right here. There's tons of articles and videos on there, as well as a free trial to join the VTS investing community. What have you got to lose? Come see how I personally navigate these unruly markets. See you next time.